Recording process. An account is an individual accounting record of increases and decreases in a specific asset, liability, or equity item. Item. In its simplest form, an account consists of three parts. 1. A title. 2. A left or debit side. 3. A right or credit side. Side. Next topic we can see. Debits and credits. The term debit indicates the left side of an account, credit indicates the right side. They are commonly abbreviated as DR for debit and CR for credit. We use the terms debit and credit repeatedly in the recording process to describe where entries are made in accounts. For example, the act of entering an amount on the left side of an account is called debiting the account. Making an entry on the right side is crediting the account. On next we can learn about steps in the recording process. Although it is possible to enter transaction information directly into the accounts without using a journal, few businesses do so. Practically every business uses three basic steps in the recording process. 1. Analyze each transaction for its effects on the accounts. 2. Enter the transaction information in a journal. 3. Transfer the journal information to the appropriate accounts in the ledger. On next we can learn about the journal. Companies initially record transactions in chronological order, thus, the journal is referred to as the book of original entry. For each transaction, the journal shows the debit and credit effects on specific accounts. Companies may use various kinds of journals, but every company has the most basic form of journal, a general journal. Typically, a general journal has spaces for dates, account titles, and explanations, references, and 2 amount columns. Journal, unless we specify otherwise. The journal makes several significant contributions to the recording process. 1. It discloses in one place the complete effects of a transaction. 2. It provides a chronological record of transactions. 3. It helps to prevent or locate errors because the debit and credit amounts for each entry can be easily compared. In addition we can see about the ledger and posting. The entire group of accounts maintained by a company is the ledger. The ledger keeps in one place all the information about changes in specific account balances. Companies may use various kinds of ledgers, but every company has a general ledger. A general ledger contains all the asset, liability, and equity accounts. Posting. Transferring journal entries to the ledger accounts is called posting. This phase of the recording process accumulates the effects of journalized transactions into the individual accounts. Posting involves the following steps. 1. In the ledger, enter, in the appropriate columns of the account, S, debited, the date, journal page, and debit amount shown in the journal. 2. In the reference column of the journal, write the account number to which the debit amount was posted. 3. In the ledger, enter, in the appropriate columns of the account, S, credited, the date, journal page, and credit amount shown in the journal. 4. In the reference column of the journal, write the account number to which the credit amount was posted. Finally, we can learn about trial balance. A trial balance is a list of accounts and their balances at a given time. Customarily, companies prepare a trial balance at the end of an accounting period. They list accounts in the order in which they appear in the ledger. Debit balances appear in the left column and credit balances in the right column. A trial balance may also uncover errors in journalizing and posting. The steps for preparing a trial balance are: 1. List the account titles and their balances. 2. Total the debit and credit columns. 3. Prove the equality of the two columns.